All right, so let's kind of get into what did those kind of leave when it came to actual numbers itself, right? So, like I said, we've taken it, we've exceeded where we thought when it came to people coming through the park. Because again, when we first started this, we were really focused on the baseball side. What we definitely saw is that there was a lot more need when it came to whether it's the community aspect of it or entertainment events. So here's basically, again, just from a high level standpoint, we can go through the more in-depth numbers later if you're interested in that. Is that here's what our total income looked like from 23, 24, and 25. Total expenses, and there's what our basically what our loss was for the last 3 years. Last year we hired basically a high-end more bookkeeping firm, I'd say, or accountant or consultant. We went through the whole Doge experience, if you're curious, last October. We probably needed to hire her much earlier. And so to really get our financials, just the structure of it, we didn't have that in place. And I'd say that's probably a big contribution as to what you look to see is how were we able to cut the expenses as much as we did. The other part of it is we were still doing a lot of construction in 23 and 24. So some of it had to do with changes from our food and beverage standpoint. Some of it had to do with building out the Sports Advantage to building out the brewery itself. So here's where the balance sheet looks at that, and we consolidate. As I said, we kind of talked about how we've started to build this as two entities. We've got the franchise, and we'll talk a little bit more about that. And then we've got the real estate, right? Because both of those come together. And so, here's a consolidated balance sheet between taking a look at the real estate and the franchise. So the other one was just looking at the baseball operations itself. But again, as we kind of get into this, you can see why that becomes pretty significant when we talk about what we're growing and what we're building. So this is where we kind of talk about getting in kind of that scoring position. What does the next 5 years look like? So Sunny's going to kind of start to kind of lead us through it. What are the 3 key things we really want to hone in and elevate over the next 5 years? I don't know if this works, but we'll try it.
Yes, sounds better.
Good.
Sounds good.
Yeah.
Well, it did.
Okay. All right, so when we talk about what's the biggest ticket revenue generator in our facility, it's group sales. Of 100% of ticket revenue, 65 to 68% come from groups, and that's across all leagues, teams. That's other than the pros, that's pretty much what our trend is in this type of facility. Having said that, we have some areas like the beach that we want to enhance, and then we have some areas that we want to do new. And when we say new, affordable new, right? We're not going to build a 350,000 steel structure with bleachers and what have you. These are shipping containers that have been retrofitted to have it above, on top of it, group area with a bar and underneath for storage.
Recording in progress.
So the plan would be from the left field foul pole up into the first light pole. We'll have 3 of them behind the home run fence. And the shipping container itself will be out of the view. It'll be lower than the home run fence, but above you'll see the party decks. Each shipping container is approximately 8 feet by 20 feet. So if we have 3, we're going to combine them to 60 feet with a portable bar out there. We'll be able to store stuff underneath and have a portable bar that will be able to serve beer. Probably an all you can drink, all you can eat type of venue. That's what we're missing here, is an all you can drink and eat ticket. So that's one area that we want to enhance. On the cabanas that you see on the second level, we've had a problem with wind, and we've had a problem with the shade systems that are loud, they rip, it's windy. So we're going to go with a more permanent roof structure for shade. The biggest problem we hear is we don't have enough shade. So the new group seatings in the outfield will have shade. The beach area will provide shade, and we'll have permanent shade above the cabanas. That's one of the major capital improvements to the facility, along with enhancing other things. Tables are getting broken, garbage cans are getting broken. We're seeing the wear and tear. Our slide that all the kids go in has a hole in it. Some kids get stuck. So those are the things that we want. Louis is not smelling good. You might want to get a new mascot. So things start to add up, right, going into year 5. One of the bigger things, and really one of the most one of the bigger drivers of revenue is media and exposure. And the league is really putting a great emphasis on Roku and getting the brand out there to multiple eyes. And we have to upgrade our audio, video, and media production capabilities. We have to add a camera behind home. We have to have a more steady pole next to the batter's eye, because if you ever watch these games, the pole shakes and it's not what we need to get to Roku standard in the technology, and then working capital, which we've never had since we started. Those are a couple of the items that we want to do inside the facility. Outside the facility, there's three boards on that back table that highlight all the development. If you just read the news about 2-3 days ago, Peter Bell and the owners of the rest of Pabst Farms is partnering with Cobalt Partners. And it's a 230 acre, they're going to develop the rest of Pabst Farms. It's next to the Costco site on the north and south side of the highway as you drive into Pabst Farms on the highway. That's all being redeveloped. Olympia is being redeveloped. Every site in the industrial park is sold and being developed. Folks out there are from Wispac. Wispac is Pepsi bottler. They're building their corporate headquarters just on the other side of our neighbor to the left out here. So when you talk about growth, there's over 1,000 homes that are under contract to be built between apartments and subdivisions. And most exciting is the opportunity to partner with one of these developers who's currently building next to Fleet Farm. They're called Wingspan. It's a family. It's a Greek family out of Chicago called the Papa Nicholas family. They own real estate. They build in schools. They own hockey venues with indoor hockey rinks, and they're managing sports facilities. And it's a big growth area for them. They have been meeting with us and want to do an indoor sports facility, almost like a center court, where you're going to have 8 basketball courts, which would be 16 volleyball, a championship court. So when you talk about opportunities to bring twice as many people to our parking lot, that facility will allow us to grow. How that helps us, now you have volume with ordering food and bev, right? As you know, when you double your inventory or when you double the ordering, food and bev companies love that, right? We've talked to Beer Capital, we've talked to Pepsi, we've talked to a number of our food vendors. It's exciting, and their sponsorships will grow. The city sponsorship will grow. So we're really excited about that. There's more details on the site plans, but it's something that would really, really grow the attendance figures, which is our #1 goal. Besides Wingspan, the cell tower just past center field, we're going to be building a cell tower. I want to say it's a 30-year lease, steady, a couple grand. We haven't determined the amount yet. We'll be negotiating with that, but that's going through the city this month for approval. That'll be finished. And really the restructuring of the financing. I'll let Tom get into that, but that's kind of the third piece of the next phase. Back to the other one.
No. A lot of you I've talked to individually. I want to say it was about right after the All-Star break, Associated Bank has our note. Back in the day, it was during COVID, if you remember, every ballpark was empty because of COVID. They were the only bank that would take a risk on building a venue like this. After 4.5 years, they came to us right after the All-Star break and said that they were not interested in carrying our note any longer. It kind of pushed us in a direction in the middle of the season that kind of caught us off guard. And with that, we've had to, understand what we're going to need to get through it and move forward. They gave us a deadline at the end of the year of 2025 here to get out from underneath that note that we have with them. So some of this restructure is
the
raise.
that's
That has already started with one of our angel investors that we'll get into, Scott will get into shortly. But the goal here again is to not get into much trouble legally, get out from underneath this loan and get into something where this company can cash flow, which I think every investor wants to see at this point. And so with that, Fox Community Credit Union is a credit union out of Appleton. They provided us with many options and different term sheets. Thanks to James Kelly back there, it was his connection that set us up with them, and we've had multiple meetings. And you know, at this point, really, it's the best option for us to cash flow. And they understand the business. They're a big sponsor and part of the Appleton Timber Rattlers, which is the A affiliate for the Brewers. So when they came in here, they understood what this kind of business is. For the record, Associated does not know. You have big leaps and big drops when it comes to revenue. Obviously, during the season, you make a lot of money, and like Lisa indicated, and Sunny, you know, we're trying to fill these low spots, and now we're looking really to fill it, not only fill the low spots, but bring in some passive income when we talk about the cell tower and we talk about partnering up with Wingspan. And to go back to Sunny's point a little bit, Wingspan is there for us not to put any cash money into, right? They really want to build on the 4 acres, right? And part of this restructured capital raise is our angel owns that 4 acres next door, right? For the record, I think he bought it for 600,000. Sonny's had some, had a sign up there, probably could have doubled his money. I think he got an offer of 1.1. But that angel is like, that doesn't benefit the company whatsoever to have a storage locker there or some corporate headquarters, right? So it was kind of a coincidence that we ran into the Wingspan guys. They came here, they want to build there. So our contribution would be to get that land under contract from our investor within this group, right? And either have some ownership in that or have a land lease with a maintenance agreement of them using our parking lot. If you look at the drawings back there, the guys who have developed before are probably looking at that going, how the hell does that work? Very little parking, no stormwater pond. So we've had many meetings with the city, and they've allowed Wingspan to build more or less tip to tip, which is important for us. And a better understanding, just to be clear on the sponsorship part, if you guys aren't aware, our sponsorship, when you look around at all the food and bev that's out here, what we go through now in the off season is volume, right? So if attendance is low, or let's just say the weather is bad, they're not drinking beer and they're not eating food, right? So our battle not only is through the year of trying to win games and put on a show here, but it's now sitting down with the performances and the beer caps and all the different companies. And they go, oh, well, maybe your volume wasn't as high, so we're going to cut your partnership. Well, that's just another dig of trying to make money and have cash flow. So again, it's thinking outside the box now and having in year 5 to have more passive income and not really depend so much. It's like we're not going to work hard to get it, but not have to worry about the numbers that are coming in because of enough passive income. So what was my here? Yeah, let's go back to the time quick. So if you guys can see it, it's 8 basketball courts, it's 16 volleyball courts. They're proposing over 100 hotel rooms. And here again, having some whether it's ownership or partnership, land lease, you know, we go through over 1,000 rooms a year as a team. So when a team comes to play us, we pay about $80 to $85 a room in Waukesha. There isn't really any owner in Oconomowoc that owns a hotel that'll even come close to that rate, right? So in theory, you know, you're more or less paying yourself if we have some kind of ownership or some kind of land lease agreement. And then again, the excess food and bev, that deal would come through us. They would have to order all their alcohol, have to order all their Pepsi and all their food through us to elevate our sponsorship number. I think they got a bar, restaurant in there as well. And these guys, what's that?
It's almost like.
Yeah, these guys have these kind of facilities in Rosemont in the Chicago area. They not only build it, they finance their own stuff and they manage it as well. So we're not looking to get involved in trying to fill this thing. It's on them. What do you got next? So obviously, here's the projected revenue. You know, for the record, we're looking, you know, we have a very well-rounded, very smart advisory board for this group. And one of the things we talked about a lot was what's our exit strategy, right? And that exit strategy has kind of been determined just through the growth that we'll talk about later in the multiplier of which a franchise like this is worth. And then we'll also talk about the real estate and what it's worth here. A short note, I think Costco paid more than 2 times what we paid for per acre here. Right, so when you look at the value of what you have here, it's more than doubled in 4 years. So this is just a quick projection. Again, with passive income, with group areas, with the cell tower, with, you know, having some kind of lease ownership agreement with the guys next door. So I'll talk a little bit about the team and the team evaluation. And I'll tell you, even when I started this, I didn't understand to a degree where this was going to go. And I say that in a good way, because I wanted it to provide a professional baseball team in a community that loved the baseball, right? But as we get further into this, you start to understand, even with the baseball background, that 99% of the sports teams in the country don't own their own real estate. They don't own the building. They don't own the kitchen. They don't own the seats. They own nothing. It's just the franchise. So when you look at this investment as a whole, it's two areas, 2 lanes. It's the franchise and it's the real estate. So with our teams here in the league, as a comparable, Kane County, they again just own the franchise, and professional businesses aren't sold by EBITDA. They're sold by what your gross profit number is, right? It's not, there's some negotiations to it, but the number is what the gross profit is. So Kane County in early 2025, right, sold for a multiplier of 3, right? So their revenue was just north of $6 million that they brought in. So obviously they sold for a little over 18 million with no assets whatsoever. Maybe the jerseys, but that's about it, right? So when we sit here and look, and again, you'll have time to go through some of this, what our gross revenue is today and what it could be in 5 years, just with natural growth. We also feel, the league has told us that they feel the multiplier within the next 5 to 6 years could be somewhere between 5 and 6, right? So if our revenue today is $4 million, and with all the passive income, group areas say it gets to 5 million and that multiplier gets to 5, which I think is realistic. You know, you're looking at a $25 million franchise, and you still own the real estate. It was really hard until about a year ago for even me to understand what is going on here, and we don't even know it, right? Some of you guys might have known me from the Five Diamonds days. You know, that was a small development compared to this, but at that time, there was no privately owned youth park anywhere. I'll say in the Midwest for sure, right? We were the city, because all of the tournaments and all these games that these kids played would go to municipalities or go to colleges to play their games. Now, if we can take a step back and understand that in 5 years, that multiplier is 5, and our revenue is 5, and we make $25 million on a sale, we're the city still. You look at Milwaukee, you look at Chicago, you look at almost every team in our league, the building is owned by the city. And I think as a group, when we get through this a little bit more, you're going to understand what the payout is if you just sell the franchise And today, for the record, we're paying $60,000 a month to be here. Today. What is it gonna be in 5 years? Obviously, our goal with the restructure is to get that down so, we have cash flow. But as a group, if we decided in 5 years to sell the franchise at 25 million, everybody's gonna get a hell of a lot of money back. And then at the end of the year, we're gonna say, what are we doing with the rent that we collected all year by owning this building? It's a super, super, super unique opportunity because you're not looking at one item to raise in value. We can't control a lot of it. We can't control the price of real estate, which we all are smart enough to know it never goes down. And I can tell you from a franchise perspective, I know Sonny sent you guys quite a few different articles that these hedge funds and private equity groups are throwing stupid money at professional sports. And as an example, the WNBA, they have a multiplier of 18. There's not one WNBA team that has their own facility. And none of them are making money, even with a TV deal, right? So when you look at these hedge fund groups and private equity groups, they might not want to spend that today, but they sure the hell are going to spend a multiplier of 5 or 6 to have a professional team in this league. So keep that in mind. Sonny will talk a little bit about the real estate.
Just to elaborate on what Tom said, currently affiliate teams are trading at 5 and 6 times multipliers, right? So it's not like we hope it's gonna happen. Affiliate teams, which would be the Timber Rattlers, which sold their stadium, Diamond Club Holdings, they sold 5, 6 multipliers, right? So what's very important for us to realize is the use of the Major League Baseball logo and the fact that we are a partner league with Major League Baseball and we can use that logo and we work with Major League Baseball brings credibility to these private equity groups. It's not just, it used to be these independent leagues were kind of on an island. They weren't a part of Major League Baseball and they're, the has-beens of the leagues and they're still trying to make it happen. That's changed and it's changed dramatically with Major League Baseball and the 4 partner leagues of which we're one of 4. So that's very critical. And the fact is they are trading at 5, 6 gross values, affiliate leagues. So the trend is going well. When we talk about the real estate value, we have 17.5 acres plus an additional 4. So we're going to have almost 22 acres. If you do the 200,000 an acre value, you can do the math, what the land value would be. However, we have a stadium on our land, right? And we control this asset 365 days a year, meaning we don't lease it for 50 games and give it back to control some other entity. We control it. So there's a company out of Tampa called Whitecap Sports. They're the sports franchise brokers in the industry. There are 3 things that drive the valuation of this stadium. One is we control it 365 days. 2 is location, obviously. And then 3 is how new is the facility? Is it a 25-year-old facility or is it 5 years? And we're in that. All 3 are positive for us. So what is the value? It's what we paid. It's what we built for it, what we paid for the land, and what it's worth today with a little bit of a multiplier, which we came up to, I think, 23 million is what our all-in cost would be for. We had to build this today. It's way more than that. That's what we paid for it through the when we constructed the building. So that's where we're at from a value perspective of the stadium in itself. Am I missing anything? Okay. I think that's it on my end.
Okay, you're the show. All right.
Everyone, if they can't hear, let me know. So this is more or less a summary of what Tom and Sonny kind of went through, but to break it down further, and forgive me for being a little dry and quick with some of the facts, but they're the ones that are going to sell it. So if you combine, this is driving at what are the units and what is the company kind of worth now, and then parlays into what are we valuing a unit at when the company seeks to sell to raise what will be hopefully $8 million? Because it has to come up with a value. And if you combine the real estate and the baseball team, you're looking at about $35 million or so using these numbers prior to the debt, which exists. So if you just take simple baseball team 3 times, very conservatively, the $4 million of revenue that it had and has a track record for $12 million plus the 23 million. And you subtract out what is non-ordinary course debt, which it has with Associated Bank and the Bryan family. You're looking at an enterprise value of 19 to $20 million rather conservatively now for the team, like if it packaged it all up and sold it. And then the investor pool, once you pay out preferred returns, is roughly half, or at this point in time, 49% of the bottom line proceeds after they get their money back, they get the preferred returns. So very conservatively, with those figures, the current investor unit values could arguably be close to $200,000 a unit. So that's something that the company wanted to share. And that relates then to the investment offering, which I can help describe. And then the structure, which will, the investment offering, I'll describe the kind of pricing in a moment, but currently on the left side of the sheet is what the structure is now. We have 2 subsidiaries, the baseball team, Blue Ribbon Baseball, and DCRE Holdings, which owns all this real estate. That's owned entirely by the parent company, Diamond Club Entertainment, which everyone who is invested and the founders are all the owners of. The proposal is to continue that forward, increase the number of preferred units that are being issued under this offering, and the new potential subsidiary relates to Wingspan, which there's complications to be worked out there depending on the structure of the deal, whether it's a leasing arrangement or an actual passive investment that the company becomes part of by contributing the real estate it wants to put in there, which if that were to happen, there would be an additional holding, which is likely to be a portion of a development with Wingspan. But as Tom mentioned, I don't believe there's an intention on the company's behalf to manage any part of that. It would be more of a passive holding because the company would be contributing the material real estate value of the parking lots over to Wingspan. The offering, and there's going to be a private placement memorandum circulated by the end of the week to memorialize this, is a hopeful capital raise of $8 million. It could be less than that. And the reason is that the Bryan family has already invested $2 million by way of a convertible note, intending to convert into equity when this raise is completed. They're holding back. Bryan family has a lot of subsidiary subordinate debt, some of which it's not intending to convert. It's at least holding back the option to not convert about $1 to $1.1 million of that. But the hope is that they convert all of it. If they convert all of that debt plus match a hopeful $3 million raise with everyone else, they would commit $5 million. And the company is looking to raise at least $3 million from everybody else, hoping for an $8 million all-in capital raise. Same class of units, same preferred return structure. The pricing, there's a 2-tier to it. And I'll explain kind of how we got there, which in order to price the unit, the company had to factor in that there's a revenue multiplier that is some meaning in the industry for professional sports teams, and we have a pretty conservative pick here. Plus the real estate value, it's hard to not, the managerial board kind of went through this, justify that the value of a unit, if we're to offer it today, went up. And it's materially worth more than it would have been previously with $100,000. So in good faith, the company sought to offer units at $175,000 a piece, but does believe it, we go for more. And so if the investors who want to participate quickly and sign up, the company wants to offer it for 175, but if, it gets later subscriptions, it would be $200,000 a unit. Targeting closing in November ahead of a hopeful refinance with Fox and elimination of associated debt. So Sonny, do you want to talk about the usage of funds?
Sure.
Because that's more your lane.
Yeah.
And I can talk about the process of these after.
So as we spoke earlier, right, we're gonna pay it off, the line of credit is almost halfway paid off, 500,000. The $9 million note with Associated Bank will come down to 4 million with Fox Communities. When we talked about the enhancements in the new group areas and improving some of the current areas, and increasing our audio video production. Those are the group space additions and stadium upgrades. Tom spoke of the purchase of the 4 acres for $650,000, which is probably a $500,000 to $600,000 savings for the company. Again, I would recommend you go check out Wingspan Development and what they do in their different companies. Obviously, we've got professional expenses and operating cash. So the primary goal is to pay down a $9 million mortgage to $4 million, and then have some capital to do improvements and to grow our tickets and group areas substantially, hire additional staff. We're short-staffed ticket sales, so that's the focus of what this goal is for the second round.
Yeah, and just to kind of add to this, when we talk about that multiplier, when it comes to the sports team, you get from a 3x up to a 6x. So I just got back from the MLB's, their fall meetings, I guess, if you will. And I spent a lot of time just kind of trying to understand where does private equities come into play in this, and how are we seeing that the valuation is going from 3 to 6, and just trying to understand what are the key things we're looking for, right? So a lot of it has to do with the infrastructure that it offers. Is it a profitable company? Right, so I know that I was talking with our commissioner, he's like, we've got 4 private equity firms that call me all the time, and they're asking about these teams. So the first thing they ask is, are they profitable? And that's where they'll start. And the next thing they look at, they talk about the what I call more technology infrastructure. So a lot of it has to do with driving the media rights itself. I know that he said that just the league alone, they had 10 million views over the year. We had one game, we had 169,000 people watch. I'm like, who are these people? I didn't even know that many people knew where we were at sometimes. But there's a lot of growth on that. But the other thing too is, from a technology standpoint, is we needed to help build up our ticketing system. We have a lot of buyers, but if you look at all the teams out there, the data, the analytics that they have are able to what's driving their ticket sales per se. We don't have any of that infrastructure in place now. So some of that's going to be enhancing just the analytics that we have, so that way we can push it out, identify more consumers, not just our ticket buyers right now, but who are the consumers? Who are they? What are they looking for? As they talk about all the development around here, we can get a better idea of who those individuals are, and not only how they might want to come to a Dockhounds game, but maybe it's going to be, again, renting the facility itself. Maybe it's going to be from an entertainment aspect of it. We're not equipped to be able to hit all of those lanes right now with the technology that we have in place there.
So this sheet here will help you understand what the balance sheet would look like after the capital recapitalization is completed. You do have a copy of what it is currently, and what it looks like now after the raise is completed. And this was another big driver of our advisory board. Again, when you look at how you cash flow and what the company looks like as a whole, I feel that a lot of our board members are extremely smart and have ran and sold some pretty profitable companies over the years. And Randy, bless his soul, he did this for us. Typically, accountants, I guess, don't do this without written documents, but I needed the group as a whole to see what it looked like done. I think when you look at what your assets are and then what your liabilities are, and then you start to cash flow, naturally the multiplier and the private equity firms are going to be excited about something like this. So I think it's extremely accurate. I think this raise is very simple from the standpoint of where it's all coming from. Not simple, obviously it's a lot of money. But we're in professional sports and we're 3 years into the operation, and I think this thing has come on extremely hard. But the light is extremely bright in the next 3 to 5 years of what the company will look like as a whole. Does anybody have any questions about the balance sheet at all? Or are we gonna go to the questions after?
I think the only thing that left is that's just kind of what the timeline is.
Explain that if you want.
I can read. So obviously we're here today, right? We're putting the units out at 175,000 today. And again, I think some of the confusion might be, it's open to anybody, right? We wanted to talk to the group as a whole first. We do have, I'm just gonna say a few, could be more that are interested in getting into this, this business because they enjoy it. A lot of them are what we call our Diamond Club members that have been full season ticket holders from day one. Some of you might have been already, but there's other ones. And then Wingspan would like to have some ownership in this as well, which I think it's a natural fit if the raise is short within. Where the way the contracts would be worded in the PPM, they wouldn't have any, voting rights. But it would bring us all together and having, a good relationship with them and them being here as well. We're looking to have all the commitments done by the 10th of November, to really get out from underneath Associated before the end of the year. And we did, like I said, get a term sheet from Fox Community, that they could definitely close by the end of the year, and have an appraisal done within 4 weeks, which is important. What do we got next? Obviously, our contacts, like I said, a lot of you I've talked to, the majority of face to face, some by phone.
This is Scott's slide.
There you go.
I can read that.
Yeah.
Read it on your own. You want to flip back to the timeline real quick? Because I think there's a couple of things I should mention. Just because it relates to documentation that's coming. So the documentation related to this is going to consist of a couple of things, similar to what all the investors have previously. A subscription agreement. There's going to be an operating agreement amendment. I'll touch on that. There's a couple of nuances. All the investors have a right, which is fairly typical, to participate in any offering that the company does. It's to ensure that you have an opportunity to invest, and avoid being diluted, if you were to invest further, which happened with the bridge round when there was the Tim Newbert redemption. But so there's a waiver that's going to be sent called the participation rights waiver, whereby all the investors are going to be asked to say, I understand I have a participation right. I'm waiving my participation right so the company can proceed with raising its capital. That document will be sent out on Friday, we're expecting, along with the subscription agreement, not intended to mean any particular investor can participate. The reason it's important is because you've got the Bryant family intending to commit hopefully 5 million, but at least $3.9 million of equity to be invested here. And so it's an imbalance in that the Bryan family has founding interest in that. They don't have Class B investor interests. So proportionately, they don't have the same right to say, we're going to participate and maintain our Class B investor position. But it's a huge check. And the company's intention is that it can close quickly. So that's that document. I'm happy to answer questions more specifically about it. The other thing is the operating agreement will need to be amended, and the company is going to send around a consent resolution in the same sequence here, essentially, proposing a couple amendments to the operating agreement. One more technical, one a little more substantive. The technical amendment is that it needs to authorize more units to do this. There are more Class B interests that need to be offered, and there are limits. The company has been, the managerial board has been very mindful of, like, they don't want to act like kings and just issue units, and the operating agreement doesn't allow them to do that. So there needs to be an increase in the number of units. The second item is that the current operating agreement has a limited redemption right for investors, that whereby after it was 5 years, there could be 1 or 2 redemptions at fair market value that the board determines. The goal is to have that right be pushed out for another 5 years. And the reason is that financially, this company's in growth mode. It's not suitable for redemptions at the moment. Also, the intention for all those investors who see the long-term vision and the bigger upside is that it's best for the company that no one wants to be redeemed. And the hope is that that's kind of seen by all the members, but you need to disclose that those changes are going to be proposed, and you'll see it come through. Don't want anyone to be kind of caught off guard when they see that. So wanted to explain it here. And the packet, again, hopefully by the end of the week. And there's also a sign-in sheet for those that are here, that if you want it to be emailed to you, note that, and we'll email you the subscription packet.
Okay, now we get to the questions.
Maybe ask James if he wants to talk at all.
Do you guys, I know both Pete and James, you guys have been at some of these board meetings. Do you want to add anything in addition for staff?
I mean, I think to keep it short and sweet, I mean, I'm an investment guy. I manage money for families around the country, and when they give me money, you know, the objective is from.
Do you want to come up here? You can use the next
Oh,
one.
not really.
Well, you come up here.
There's a lot of people listening.
Yeah. And then if anyone has questions from Zoom, they're gonna just type in the chat and we'll share that, so.
I'll be quick.
You don't have to clip, you can just hold.
I'll just hold it. Can they hear if I,
Yeah.
you guys hear me?
You're good.
Yeah, so I'm an investment guy, and I've sat in some of these meetings, and I think what I would say is, you know, when you invest your money, you want to get a return on that investment. And I think what, you know, Lisa and Tom and Sunny have put together here, objectively, in the first 4 years, I mean, we've been collectively playing defense and just trying to sort of survive. And even in that environment, you know, I think to Scott's point, we pretty conservatively doubled our money in 4 years. I think with this capital raise and the benefit of having some actual, you know, resources to play with, I think we touched on the streaming. I personally think that media rights is kind of what drives professional sports valuations. And we haven't even scratched the surface of that. Tom, I think, has done a great job in emphasizing the uniqueness of this opportunity is that we own the real estate. And I think most people, you know, you may or may not understand how a business works or how a sports franchise works, but I think we all, at least on some level, understand how real estate works. And That's a huge asset, you know, to Tom's point. Even if we sold the franchise, we can still own the real estate, own the facility, and be landlords for, you know, another 10 or 20 years and collect rent checks. Not that we're necessarily looking to do that, but anyways, the long and short of it is in 4 years, without even really trying, we've doubled our money. I think the sky's the limit on what we can do in the next 4 or 5 years when we're actually trying and have some capital to reinvest in the business. Reducing our debt's going to improve the cash flow immensely so that we have on a monthly basis, again, assets that we can reinvest and make improvements in the stadium, develop our media capabilities. So I don't know. I think, I feel like there's a lot of information that's been shared and it's easy to lose sight of, I think at the end of the day, what's important to most of us, which is to say, how much did I put in? Or at least it's the conversation I have with my clients. How much did I give you? What's it worth today? And, you know, what do you think it's going to be worth 5 years from now? We took, you know, you put $100 in, it's probably, you know, worth at least $200. I would argue that it's worth more than $200 today. And I think, you know, based on what the game plan is going forward, I don't see any reason that we're not having another, you know, when we're sitting here in another 2 or 3 years, that we've doubled it yet again, if not beyond that. So for whatever that is or isn't worth, that would be my 2 cents.
Questions? Yes.
I do have a question. So when Brian converts his note, there's going to be some dilution to us existing.
Yep.
Okay, and then after this capital raise, there's going to be more dilution. So right now, each unit is worth how much of the company? 1%?
Can you repeat the question so they can hear it?
The question was, when the Bryans convert to their note to equity, there will be a dilution. And when the balance of the remaining funds are raised, there will be an additional dilution. So today, what is the current value of each share
Percentage,
percentage?
and then what will
Oh,
that
okay.
percentage be after?
And what would the percentage be before and what would the percentage be after?
That. Can this thing reach me?
Yeah.
Great question. First, worth noting that the Bryant investment is intended to convert at the 175,000 a unit. It's like the same deal that everyone else is getting. At present, a unit, you bought one unit for $100,000. You effectively have 1% right now. Now, there's differences to that because all of the investors have preferred returns. So their units are inherently more valuable than the founders' units. And the preferred returns have accumulated. And at this point in time to be like $1.9 million worth of returns. Is that right, Sonny? So keep that in mind.
Please.
If a 1% holder doesn't invest, and this is a very rough figure, just to kind of get an idea, and we raise $6.9 million, and Brian doesn't decide to convert $1.1 million, which would remain debt on the company. So not impacting the not, you know, increasing the price or anything like that. That investor would drop down to approximately 0.72%. If Brian, and you know, you've got these numbers across, we're not sharing because they're fluid a little bit. Changes a little bit if it turns out that Brian's investment is getting $5 million and that investor doesn't invest, they drop down a little bit farther. In order to maintain your position, you have to invest, which is the case with any organization that raises capital and issues additional units, because they're not fixed. In order to maintain your investment, you have to participate further. Companies going up in value, which the numbers show. I'll pause there if that answers the question, or want to go farther. To help.
So I think I might need to go a little further. So you'll be diluted to about 3/4 if you don't invest, potentially 60%. From the sounds of it, 60 to 70% will be diluted if we don't invest.
Yeah, the question was, what's the extent of the dilution if there's no investment? And I think keep in your heads probably around somewhere between 60 to down from 1% would go down to somewhere between 0.6 and 0.75. And just to roughly assess that.
Okay, if we match our initial investment in units. Let's say you bought one unit at the beginning, we'd have to invest another one unit at the 175.
Not quite. So if your goal is to like, hypothetically, if your goal is to say, I want to continue to own about 1%, is that sort of the question? Right? If you wanted to own about 1% using the values that we've got here, that we're working with, is you want to buy about half a unit. Because the units have gone up in value. So if we're saying a unit out of 175,000, if you purchase that whole unit because of the, I'll explain one point in a moment why that occurs. You would actually increase your position, and the reason is that the founder's positions go down. So what exists now is 51% after factoring in preferred returns for 49% for the investor pool and 51% for the founder pool. The founder's position will be proportionally ratcheted down because of the new units being issued, okay? So that 51-49 split is going to be changed. The bottom line after preferred returns and capital is paid back, distributions that the company would make if it's sold would now be split differently between the founders and the investors. The investor class would have an increased position. It depends on the number of units that we sell, so that's why we can't give you like an exact amount. But if we did the full capital raise, you'd probably be looking at 63% would go to the investors and 37%, there's fractions in there, rounding, would go to the founder. And because of that, you're not really, you're owning not quite like exactly 1% change bids. So you don't have to buy a whole unit to have your position be maintained, if that makes sense.
It does.
Yeah.
So the new units, assuming all the units are sold, what are the new units? What will those represent? Obviously, they won't be 1%.
If you held,
No, so the new units purchased, say I'm a new investor coming in.
Yeah.
And I'm buying a new unit.
0.72%.
That's it.
I mean, and this is subject to kind of us.
I want
watching
you to
this,
do
and
it,
then-
just
so
ballpark.
this is ballpark.
Yeah,
Okay.
I got you. No problem.
Yeah, I'll push your slide. We just want to slide.
Does everybody here understand the Bryant's position and how their contribution works?
Well, it's right now, it's just a loan, right?
Well, part of it's a loan. Part of it was a cash infusion already. Right, so. They wrote a check for $2 million, I'll say 2 weeks ago, right? They said their ceiling is three more, so 5 total, right? If we only raise, let's say, $1 million, they're only gonna put in $1 million, right? The snowball effect of that is, if we only raise $1 million and they put in $1 million, we're $3 million short, and Associated's not gonna be happy with me and Sunny and Tony for sure. Just so you understand that, right? That the 5 million is there to get for this company to cash flow and grow if we raise 3. And it's not all on you or anybody here, right? We were gracious enough to raise 4 million from the start from this group. We had a $9 million loan. I think that went down currently to 8.4. Right, so it was kind of like a master plan when Wingspan came to us. We understand over the years where our growth could be, not only in the stadium, but passive income as well. And we got to get our claws on that land next door. And it has to happen.
Can I mention, reiterate something you just said? So all of the Brian money to date has been loan. And this is a moment where the company is having hopefully $5 million of the Bryant money be invested as an equity investment, which does a tremendously positive thing for the company's books and ability to pay preferred returns eventually. The most recent check that the Bryants wrote was pursuant to a convertible note, with the hope of having that converted into equity. What I don't think, and what Tom mentioned, and I don't think I said it clear enough before, is that the deal with the Bryant family in general is that in addition to that $2 million, they will invest up to $3 million in a pure equity acquisition of these units, matching exactly what other investors put. That's what they've said. So investors put in $2.2 million, the Bryants are agreeing to invest $2.2 million more, up to $3 million.
So what does the 6.9 come in? Because that would be 6.
It's, if part of, it factors into how the company very conservatively went about assessing value. It's someone has to be honest that there is a portion of that Bryant loan, the convertible loan, that they have an option to convert. They're not going to be able to do it. And the reason that came about is because at present, if you look back at the slide that says the current debt position of the company is around $15.8 million, the exact number. The Bryant family in general has issued a number of loans. One was through Century Fence, and that's being paid back. The family wants to kind of reserve the ability to hold that portion, about $1 million to $1.1 million, as a debt interest as opposed to a capital interest. It's just the family's intention to do it that way because it's a debt interest right now. And so if that never converts, we are effectively raising $6.9 million in that aid, because the company would have to hold that $1.1 million on its debt still.
Other questions?
I do have another question. Are you doing IRA money for this? Are you able to take qualified money for this?
Yeah, it's something you can talk to, because James was another driver of this, right, as an option, right?
Yeah, I can speak to that, and maybe Scott, you can add your,
You want to go first?
you can muddy the message with your. I think the short answer is yes, I think we'll be able to. We couldn't do all three of it in tax deferred dollars, but I don't know that anyone thinks that would be the case anyways. So there's a limit as to how much of your equity base you can have in tax deferred dollars. But in speaking with the custodian that I've used in past deals to make private investments with tax deferred dollars, they have no qualms with it. There's some paperwork that Sunny is working on. So the short answer is yes.
I can explain a little bit more.
Scott can ruin that.
No, that was great. I hope everyone heard that. James might come up here again.
No.
Yeah, there's a potential that the company can accept money from IRAs. The challenges are twofold. One, there's a few bells and whistles, and we're going to add something to the subscription agreement about this, and that the company doesn't want to ever be in a position to be a fiduciary and have to pick up ERISA duties or anything like that. So it's got to be kind of careful about how much. That threshold is not going to be reached by the amount of IRA dollars that we folks might want to put in here. The more challenging part is ensuring that your custodian is willing to sign the documents and have you put the money there. But talk to James if you need a more flexible custodian. But that's the challenge. So if it's self-directed or you've got custodian that says like, well, this is a private investment we can do as long as the paperwork lines up, there's nothing preventing the company from accepting dollars from IRAs, so long as there's a push out option. If there's an issue with the IRA that the company it doesn't want to have a muddied investor pool, and it doesn't accept a high enough level of threshold where you gotta worry about a risk on. And we would control that. Like, that's not gonna be.
I would offer up that if anyone is interested in going down that path, I'm happy to have them reach out to me or be involved in those conversations, and I can facilitate the introduction to the custodian. The firm acceptance of it will be when they get the paperwork back from the DAC hounds, the custodian looks at that, but they've given no indication that no matter how that paperwork comes back, that it's gonna be an issue, so. That's why I'm saying, I think I'm comfortable saying the short answer is yes.
Who's your custodian?
They used to be called Midland, they were bought by Equity Trust, I think it's called.
Okay.
There's a bunch of them out there, but I've used up to them in the past, and so, I mean, I don't want to assume anything, for those that have IRAs, that's oftentimes a pool of assets that people don't think about in terms of making investments like this, because they think that you can't. But in fact, when you can, not only is it an opportunity, it's a tremendous opportunity. I mean, there's a story about how, the Jeff Bezos, some of the wealthiest guys in the world have been able to park interests in their businesses when they were still privately owned inside either their IRA or even better, their Roth IRA. And then you get this, exponential growth in a hot asset. And now not only have you made a truckload of money, but you've done it in a tax deferred or it's a Roth IRA tax-free wrapper. So if anyone is contemplating and has an IRA or a Roth IRA, I would, on behalf of the DAC, I strongly suggest that you contemplate doing it inside of either of those accounts rather than with taxable dollars.
I wanna talk more to them about this.
And I don't have this thing.
So I just want to talk about again, because there was quite a few people that asked about exit strategy that I had talked to. And to emphasize again that you have two different lanes here, you got the franchise and the real estate. And big picture, and I think I went through this with Scott, and if we looked at the franchise and we get it to just say $5 million in 5 years, which is only $1 million more than what it is right now. And the multiplier goes to 6. It's $30 million just on a franchise sale alone. Today, we feel that the stadium is worth $23 million. Big picture is we started with a $9 million note and a $4 million capital raise. And when you look at the numbers and say, how the hell did we get here? That's a damn good question, right? When you look at the first 2 years of all the sponsors that are out there, none of that was ever, say, total revenue that we could count on, because it was paying off the growth and the construction of what we actually have here. And I say it a lot, we had a Ford budget and we built a Mercedes, right? And so it's been difficult going through it. But I think there were certain things we had to do to continue the train to keep going. So there wasn't even a bigger gap at this point for us to swing this into instant cash flow. We got a hell of a base in 3 years operating, 4 years being in it. And we've just come a long ways. And I think this raise will put us way up and above and beyond not only everybody in our league, but getting back to 99% of the franchises do not own their own facility. So that's what I, again, wanted to punch on.
I just look at next steps.
Next steps.
Oh, yes.
What are we doing? We got a it's a Taylor Swift event on Saturday.
Oh,
No,
not-
I'm just kidding. I'm just kidding.
We do
Oh, we
that
do.
Friday.
Yeah.
Want to hear your album?
Yeah. No, what do you want?
While you guys are talking, if I could just reiterate or re-emphasize what Tom just said, because I know this was a point that I had never really been clear on, which is the exit strategy, which is, I don't think it's anyone's objective to still be, owning this asset, at least in its entirety, the franchise, in another, 10 or 20 years. So at least from the board's perspective, I think our objective is no different than any sort of small and growing business, which is how do we grow that top line revenue number as quickly as possible, try to make that trajectory as upward sloping as possible, make it an attractive asset, and then, test the waters to see what the appetite is from, other strategic buyers or private equity or whomever it might be. So know that when you're putting your dollars into this opportunity, that this is not intended to be a 10 or 20-year commitment. This is something that I think we're all hoping to at least get some amount of liquidity in a meaningful way in the next, I think the board has been discussing somewhere in the neighborhood of 5 years plus or minus. At least for me, it's helpful to know that, as you're contemplating what you want to do or not do.
And I think to take it a step further, if you look at the 5-year mark, if you look at the balance sheet, right? As the post raise, and then you project out 5 years, that $4 million note that would be with Fox Credit Union would probably be somewhere in the 3 to 3.5 range, somewhere in there.
Yeah.
And you got the Bryant debt, the rest is profit.
And Tom's totally sandbagging to suggest that with 5 million in revenue, I mean, we got, again, to 4 without, I don't want to say without trying, because that would be a slight to Lisa and Tom and Sunny, but 4 without having, kind of having one arm tied behind our back. So if we get both arms freed up, we replace some offense, I don't think there's any reason that number shouldn't be a high single digit, if not a double digit number, with a 6, 7, 8 multiple attached to it.
Lisa was at that convention in Indianapolis and ran into another GM in our league. And she had asked, how many salespeople do you have? And he said 9. And we got 2. Because again, that's all we could afford to pay in a base salary. Now they get commission, right? But what would it be like to be able to say, yeah, we can afford 3 or 4 more salespeople, add group areas, add passive income? What does that number get to be? We're going to be conservative.
All right, so next steps, if you guys have questions, that's what we're gonna hear. So if you got a question for Scott, if you got a question for Randy, if you got a question for any of us, Friday, your team is sending out.
Yep. And for those that are here, make a note on that sign-in sheet if you want, you have a form. The reason I say that is because if you want it by DocuSign, we can make it fillable. It just takes the paralegals a lot of work to do that. And we don't want to waste time and legal dollars, frankly, if we don't want a form email to you. On Friday, we are anticipating sending out, I'll back up. Possibly Thursday, we may be sending out the consent resolution to authorize what would be effectively authorizing the operating agreement amendments. There's a certain portion of members required to say, okay, for that to be deemed effective. Super majority of them. Which once you add it all up, it's not everyone. So there's a way to, if someone dissents, it's not like we can't amend the operating. But that's likely to go out on Thursday. On Friday, likely to go out is going to be a short form private placement memorandum that really just summarizes the offering and adds disclaimers, yes. And attached to that would be the new operating agreement, a subscription agreement, which would memorialize someone's decision to purchase a unit. And I believe a spousal consent will be attached to that. But other than that, those documents in the subscription agreement, once signed and submitted to Tom, would effectively be the commitment. And the hope is that those come in quickly for those that are interested in investing. It allows the company to project further how many more units it needs to sell and who it talks to, and obviously would prefer that the group, I think, get them there, and then it allows the company to communicate with Tony about what happens next. Because the November timelines are real as far as intending to restructure with Fox Community Credit Union.
Alright, so we've got until the 21st. Get your rate or your share at 175,000. Then after that, it goes to 200, and then we open it up to current investors and also new investors. Okay, everything's got to be finalized by the 10th of November, so that way we can make sure everything's finalized and finished by December 15th. Okay.
No question?
One big question, what happens if you don't raise it?
I'm probably, Sonny and I are gonna have 3 squares a day the rest of our life. No, I'm just,
I guess that,
Yeah.
what's the bank gonna do? Will Fox Valley still get you the loan, so they?
well, the term sheet we got is, it was originally 4 and we got it up to 4.2, right? But if we don't, raise the money, and I'll give you a little tidbit of, we, for the first, up until, like I said, above the All-Star break, so we were paying a mortgage for, what, a little over 4 years. We're never late, never missed a payment to this minute, whether it was interest or principal. It got flagged because of a covenant. The loan docs there were 460 pages. And there was some fixed coverage ratio that they want so much cash at the end of every month, right? We were never asked for it. It was never checked the whole time. Our loan officer has left Associated. New people got brought in, got flagged. They said, we need you to make a cash injection of, it was around $2 million into their bank. And I'm like, no way. Because that 2 million doesn't do us any good, right? So, we have to get it done by the end of the year. Because they're out. That's simple. It's a tough situation. I think we're gonna look back and go, it was the right time with Wingspan. Again, another year in a business this size to understand it more, is extremely helpful. And, it was a rough road here the last couple months. Yeah. But
I guess it's not really an option. I mean,
No,
the
it's
more
okay.
and
I
more
guess
we
that's
kind
right.
of take a look at what this can be, I think the more committed we are to make it happen, right? I think the most unfortunate thing is we've been forced into a much shorter
Very
runway.
short period of time to do this, that's a
Yeah.
lot of money to raise.
Yeah.
And
So,
right before Christmas.
you know, is it the right
The market's
direction?
going
I know.
down. I mean, it's not.
No.
You know, and I go back to, again, I mean, a lot of you been to those conferences or go to conferences and all that, and some are good, and some can be a waste of time. And sometimes you just have to go to kind of get refreshed and kind of realize exactly what we've done. And, you know, we've met with all of our food and beverage vendors. Again, we were a lot more, I mean, we were very intentional on the different things we did this year to make improvements, all right? Every food and beverage vendor we sat with, we were the only client they had where our sales went up. Beverage went up, food went up. Everyone else in the marketplace has gone down by at least 6%, whether it's beer, spirits, if it was food. When I was at the meeting, the attendance has gone down 6% across all MLB teams, whether it's affiliate or if it's at the big league level itself. We have only gone down by 2%, right? So everything else around us is taking, I think, bigger, have gone back bigger. We've been moving forward. So that's why a lot of things, the footprint's in the right place. We're moving in the right direction. It's just we're carrying a really heavy weight, right? And every year and every month, it gets a little bit less. So, you know, when you asked that, you would ask me that in July, I would have said, we're done. We won't be able to make this thing work. The more and more we've, I think, talked through it and visualize it, and see what's available out there. There's no option not to do. So it might kill us though, but maybe we'll add vehicles, yeah.
Who's gonna take
Yeah.
that spot?
But,
But to really make it simple, on the $9 million note, we're paying $60,000 a month in a mortgage. Right, a $4 million note takes us to about 26,000 a month. Right, so even if we did the same numbers, had no other passive income, we're cash flowing. And the balance sheet looks better, right? So, and again, it's hard that, the people who know me, I'm not a patient person. It's only been 4 years. So,
I think I just want to make one more cut. We want to exhaust. Right, you want to control this race. You don't want to go to private equity. You don't want to go to the big fish that are gonna skew all of Scott's numbers and really all of our numbers. So I think with the plan in place that Scott's put together, if we can keep it in-house without going to private equity, we got a great shot.
So that's your next step.
We have outside investors like the Papa Nicholas family that went in, but I think before we go outside,
Oh, that's right.
that'll
cover it.
so,
So.
that's the goal, right? So, but like Lisa said, we don't have another option, and failure isn't an option, so.
anybody else? All right, everybody on Zoom, thanks for joining. If you got any questions, obviously you can reach out to Lisa or me or Sunny. And hopefully we'll hear from you guys later in the week. Thank you.
Food. Going anyways.